The other, so I've been away, as you would recall, for Wednesday and Thursday council meeting. Actually, very interesting. Actually, quite interesting. I could talk to you about it, but I'm not going to because there's lots of other interesting stuff. So, first of all, I missed those two reports that came out on Tuesday, didn't they? Tuesday afternoon. And then obviously the other thing was the official cash rate and the Reserve Bank lowering by 0.5% the official cash rate. That feeding through into mortgages immediately. Yes, but still quite high, really. And what do you do? And on that issue, we're joined by a mortgage advisor who has got 20 years' experience in this particular issue, in actual fact, and has a great deal of expertise and can tell us what's going to happen with mortgages over the next year and what you should do. Should you fix or you float? Bruce Patten joins us now. Bruce, welcome to the show. Bruce.
Good morning. Yes, hi. How are you?
Yeah, good on you. Listen, you are a mortgage advisor. You've been in the job for 20 years. Your job is to advise people, do this, don't do that. You've seen all the events of the past week in terms of where the Reserve Bank's going. What do I do? Do I fix or do I float?
Oh, I wish I had that crystal ball, but look, at the moment we believe, and I've been saying it for some time now, that we're nearing the end of the cycle. The Reserve Bank made it really clear that there might be a couple more 25 basis points, but neutral OCR is going to be 3.25, so we haven't got long to go. We're sort of saying to people, now is the time to think about some of the longer term fixed rates, if you want them. So some of our investors have jumped into sort of the 3-year fixed. Westpac had a 4.99 running, which finished yesterday for 3 years, but I notice ANZ's now bought out a 4.99 for 2 years. So I think now is the time, if you want security, to look at something a bit longer. We've certainly got some time on your hands, so you don't have to rush. So there are still people opting for the short term, hoping that the rates will go lower. And they may well, but we have been saying for quite a long time, if we see something with a 4 in it, that's probably where it's going to end up. We're not going to go back to 3s or 2s like we saw in the crazy COVID period. The Reserve Bank is now basically just fixing up, the errors they made, which they admit they went too low, which meant they had to go too high, and we're settling back in the middle, which is going to be something with a 4 in it.
Okay. You're right. The Reserve Bank, although here we go again, we've just been talking about accountability of the public sector. No one lost their job at the Reserve Bank. Plenty of people have lost their jobs as a consequence of them botching their monetary policy. The public sector and their lack 100%. Of accountability again. Dreadful. Listen, just going on that though, I'm interested in your thoughts as to the economy, because that would set the environment in which people will feel confident enough to go back into the housing market again. And also on house prices as well. So is there a correlation in your view between the economy picking up and house prices picking up, or are they not necessarily linked in your point of view?
Well, I mean, we're seeing green shoots, right? So we've had farmers now, their positivity is the best it's been in 10 years. So that's a good thing, because agriculture is such a big driver for our economy. So they're going to be out buying new tractors, and they're getting good payouts at the moment. The housing market, I think, has got some ways to go to give people confidence in it again, because we've been through a sustained period of decreases in value. So a lot of investors haven't been there, but psychologically, this interest rate with a 4 in it, you will see a pickup in activity. I'm absolutely convinced. It won't be huge, and I'm not expecting big price increases in the housing market this year. However, I do see 2026 as being a real return of the housing market. You'll see what will happen. The old saying is that you get into something when everybody's getting out of it. So that the savvy investors are now out there buying. What will happen is that flow-on effect will occur, and you will see everybody will start to feel like they're missing out. And in 2026, you'll see the housing market starting to come right. We probably won't see ridiculous 45% value increases or anything like we saw during COVID. It was driven by a completely false economy with interest rates at 2%. But we will see a steady return in the housing market. I'm convinced of that.
The other thing that CoreLogic and others have pointed out in doing, and I think the Real Estate Institute, is how variable the market is around the regions. And rather than there being a sort of national indicator that this is going to rise, house price is going to rise here, house price is going to fall, there are certain areas that even if, as you described, there are more favourable trading conditions next year, house prices in a place like, for example, Wellington, let's use that as a good example, won't necessarily rise in the same way as they might in, say, I don't know, Hawke's Bay or Auckland, or the Queenstown Lakes area.
Yeah, look, poor old Wellington keeps getting beaten up, doesn't it? The reality is Wellington's always been one of the most stable markets in the country. It never used to go up too much or down too much. Again, complete false economy with the number of people that were brought into the public sector during the 6 years that Labor were in. It created a false economy with people buying there. And of course, what happened, just like I was saying with the housing market, once people started buying there and the house prices started going up, everybody wanted to have a part of it. So you were having investors buying that perhaps wouldn't have bought in Wellington previously. And they're all the ones that are getting stung now. So no, Wellington won't pick up. Wellington's got a lot of pain to still go through, probably with some more cuts in the public sector. So it's gonna take a while for it to recover. And you will see little pockets in New Zealand that are completely resilient to the whole thing. You talked about the Lakes District. Queenstown market has been very resilient in this whole time. Christchurch has done pretty well.
Christchurch,
as well, because of the rebuild from the earthquakes and stuff. They're creating some really good areas that people want to invest in. So no, there will be areas that won't recover as quick, but you will see the main places like Auckland, Hamilton, Tauranga, Christchurch will keep going well as far as I'm concerned. It's just going to take a bit of time. Don't expect it to happen
the other
quick,
factor we don't talk about though, and Bruce, and here we are talking about the economy picking up, the official cash rate, mortgages, that stuff, is the affordability of. I would imagine that the average New Zealand household, and it's a point that Craig Stobo makes quite often on the show, mostly as a consequence of inflation, but also the tough economic circumstance the last couple of years, has actually gone backwards in terms of how they can afford to pay a mortgage. Do you see, and the banks started tightening up, was it a year or two? You'd know about it much better than me, on that affordability test. In other words, can you service a mortgage? And what are the tests around that? Again, when you talk about ridiculousness for a wee while there, it's almost, wow, there wasn't one and suddenly there was. How do you see the banks and their lending process over the next couple of years in terms of that issue?
Yeah, so what we've got is when the rates were 2, someone could borrow 10 times their income, half the reason the housing market went so crazy. Now the Reserve Bank has introduced these multipliers on your income, so maximum 6 times if you're a owner-occupier, maximum 7 times your income if you're an investor. So the banks have to adhere to that. Those multipliers really haven't affected us while rates have been 7% because the test rates the banks were using were 9%. So now that we're getting down into the 4s, people's borrowing capability has gone from, say, only maybe 5 times. It's now creeping closer to 6 times. So that limiter that the Reserve Bank's introduced, that multiplier of income, will stop people from spending too much. Hence, will hopefully subdue the housing market and how quickly it goes up. And it is going to have an impact on, how much someone can borrow. And that's unfortunately going to mean that they're not going to be able to spend as much on a house that they might have otherwise been able to do, during the 2020, 2022 sort of period. So affordability is still going to be
I've asked this question a lot. My children are are in their, well, my younger children are in their late teens. Now, one of them's just turned 20. So I imagine over the next 10 years anyhow, they'll be coming to that question of, do I own a home? We'll be any better placed in a decade's time, do you think, in 5, 10 years, as to whether or not owning a home is still a good thing? Is this a generation that are going to grow up and go, I think we'll go the continental way, thanks very much, because it's just too onerous? And you're also trapped. Maybe Wellington will teach people a lesson about getting trapped in a mortgage where you can't even afford to leave the city because you just lose too much money. Do we re-examine the good old Kiwi ethos of owning your own home?